Okay, good morning, and welcome to another edition of In the Room with the Nate. It's always great to have everyone here, and we always appreciate your time, taking time out of your diaries, your busy schedules for joining us. I am, as always, I often forget to introduce myself. My name is Steve Backhouse, and I am the host of the In the Room webinar series. Today we are in the stunning OMIG, Old Mutual Investment Group offices in Pinelands. It's actually a massive campus. I got lost on the way here, but it does come with a lot of benefits, I was told while we were chatting. So today I'm joined by Nicole Martins. Welcome, Nicole.
Thank you.
Yeah, good to have you here. And today we're going to chat about responsible investing, and very much through the lens of stewardship. And actually our theme today, and I'll make sure you get this right, are asset managers truly empowered to invest today to solve for tomorrow's problems? So I think it's a really, really cool and interesting theme, and I'm looking forward to getting into it. So as always, just to start, a couple of house rules. The webinar is one hour long, so we'll end 10:30 on the dot. We try and make these as interactive as possible. So Nicole and I will chat, we'll have a conversation, we've got lots of interesting questions to get through. Nicole's very passionate about responsible investing and particularly stewardship. And after about 20-25 minutes, we'll open the floor to questions. So please post your questions on the Q&A tab, and then my colleague Arifa will help me out in terms of posting them on my side. And then we'll ask the questions. Then we'll get back into the conversation, and then, as I said, we'll end at 10:30 sharp. CPD points, ever important CPD points. If you're able to attend the full webinar, you automatically get your CPD point. If for whatever reason you have to drop off after half an hour, 45 minutes, you will still get the thank you emailer, and in the thank you emailer there's a short assessment that you need to complete for the CPD points. So I hope I haven't forgotten anything, but let's get started. So again, welcome Nicole, and thanks so much for joining us. So maybe as a start, maybe if you can introduce yourself so the audience get a better sense of who you are and what you do. I know you only joined OMIG, I think it was in May this year, so you're quite new to the team.
Yes, yeah, thanks, and thanks again for having me. It's good to be here, and always excited to talk about stewardship and what we do. Like you mentioned, I'm new to the team. I started in May, officially heading up the stewardship activities for Old Mutual Investment Group, and we'll talk a bit about what that means in a moment. Prior to that, I spent about 5 years with the Principles for Responsible Investment, which is a UN-supported program that works with investors on how to integrate ESG into your investment processes. And I was heading up Africa and the Middle East, so working with our signatories across the continent and in the region on that. And before that, for my sins, was in various sort of consulting roles, also focused on sustainable development and environmental and social and sort of governance plans and integrated development programs and things like that.
Okay, cool. And so just again, so you say you head up this stewardship piece for Old Mutual Investment Group. So maybe what exactly is stewardship, and what does it entail?
Sure. So definitionally, so to steward something is to take it into your care, right? And to look after it on behalf of somebody else. When we're talking about it in this context, we're talking about a really core component of responsible investing, right? So when we think about responsible investment, and I know that it can mean a lot of different things to different people, and there's a lot of jargon and a lot of acronyms in this space. So when we talk about it, we see it as really two core processes, right, as investors. The first part is about asset allocation. So when you're integrating environmental, social, governance factors into your risk-adjusted return calculation, so deciding where to put your money. The second part, and they're sort of mutually reinforcing, the second part is once I've decided to invest in something, how do I actively own that asset? So how do I steward it in a way that makes sure that it's moving towards more sustainable, more inclusive operations, that I'm consistently identifying and appropriately monitoring and managing the most pertinent ESG risks, for example. So that second part, so dealing with the companies that we have invested in and making sure that they're appropriately addressing those ESG risks and opportunities, that's stewardship. So I'm heading up the activities for that, for the whole group, so for our internal clients, and then we have some independent external clients whose assets we don't manage, so we don't do that first part, but we do the stewardship component for them.
Okay. So I mean, so you're saying that almost, what I'm hearing is there are two parts. So one is kind of there's almost the investment piece, which is the asset allocation piece, if you like, and the second piece is actually the engagement with the organizations, companies, in terms of making sure that they are doing what they say they're doing, but also then bringing it back to kind of your responsible or ESG factors. Am I summarizing it correctly?
Yeah, and I mean, I divide them because they're sort of at two different levels, but they feed into each other, right? So the stewardship activities also affect how much you allocate to those companies, right? So if you're not seeing what you need to, and the objective of the stewardship is to make sure that we're effectively managing the risk of those companies so that they remain a going concern, right? It's about maximizing return in the long run. And we know that the best way to do that is to have sustainably operating companies. So the stewardship component is a reinforcing of our decisions around being a long-term investor and making good picks.
And I suppose the stewardship conversation has probably moved along quite a lot in the last 5 or 10 years because of ESG, or responsible investing. So I remember having a stewardship conversation as I had probably 8 years ago with the Standard Asset Management guys, and it was very much along the lines of, is the board or the management the right people, and are they doing what they say? And now that's obviously still a very important part of it. Am I right?
Yeah.
But the second part now, you're saying, is are they actually doing the right thing in terms of a responsible investing piece as well?
Yeah. So I think when we look at sort of ESG, so my personal opinion is that the G is that sort of, it's the cornerstone, right? Because if you have the right governance in place, it's much easier to address the environmental and the social risks that you face. If that part is not solid, then you're in trouble. So that's a really good starting point for all the engagement. But what's happened is that over the last sort of decade, there's this big transition that's happening globally, and a lot of pressure is on financial services and on institutional investment, particularly around taking into consideration things that we would have previously considered to be non-financial. So things around environmental and social and governance risk, because we know that if we don't account for them now, we end up paying for them later. So they're fully relevant and material to how these businesses operate. So the stewardship focus is really around, first and foremost, you've got to make sure you've got the right leadership in place, the right governance in place to effectively address those. And then it's about really pushing these companies to say, look, we all understand where we need to be and by when we need to get there in terms of specifically something like the climate emergency. So what is your plan? And how are you progressing on that? And my role is to keep pushing them and to say, look, we need you to be addressing this, not because of any moral or ethical or values-driven approach, but because if you don't take this seriously, you're not a good investment anymore for us. Right? And so that's the bulk of the conversation now. It's a lot more pressure around what's your just transition strategy? How are you working on lowering your carbon emissions in this transition? If you're looking at new technologies, what does that mean for labor? How many people are being redeployed, retrained, retrenched? What's your strategy for that? How do we minimize the negative? Are there opportunities to do more that we haven't taken advantage of? So the conversation is much broader than, which directors we're electing.
And also, right thing is that, ESG and responsibility isn't just a tick the box anymore. No. So I think that's something that's almost a myth that's hopefully been bust, or is still kind of being bust. But actually, these conversations, am I right saying, are very much important to actual investor returns. So you have the view is that if you're not doing these types of activities, well, actually, in the long run, you're not going to be a performing organization.
Yeah, absolutely. Yeah. So I would think, a really good example is if you think about the climate emergency, right? Yeah. So we think about these kinds of claims a lot of investors have made in a lot of countries and companies to hit net zero by 2050, right? So you would have heard a lot about that. We don't have to go into the science if anybody wants to. I'm happy to talk about that another day. But a lot of asset managers and asset owners are setting this target. So they say, okay, we want our portfolio to be net zero by 2050. And there's a couple of ways that you can get there.
Yeah.
The quickest way, by far, is to just take a look at your portfolio, who are the biggest emitters, and just kick them out, to divest, right? There's some context in which that works, where it makes sense. So like in Europe, you see a big divestment movement at the moment from fossil fuels. In this market here, it doesn't really make sense because you would have to throw out things like Sasol, most of the mines. As an investor, you would be so far off the benchmark, you'd have so little left to invest in. Also, by pulling your money out, it creates a problem, right? The one is that it creates a big gap for another investor to come in who maybe doesn't care about this stuff, and that company can just carry on unabated. And it doesn't solve the problem. It doesn't address the problem. So divestment, is not really a viable strategy in this market. Never mind the social implications for, pulling funding from one of the country's biggest employers. So for us, that just doesn't make sense. But it is a very easy way to achieve your own individual objective. So you will see a lot of managers talking about that. The second option is to offset, which you also have heard a lot about. So that's where you say, I'm not going to change the core of my portfolio, but in addition to what I've got, I'm going to also invest in some sort of greener or negating activity. So I'll also invest in renewable energy, and that'll sort of, in my mind, make a balance of my emissions. Again, you've not addressed the problem, right? So that leaves you with really the third strategy for achieving something like net zero, which is what the science tells us we need in order to avoid the worst impacts of climate change, and that's around stewardship. So that's saying, all right, but look at my portfolio. Who are the biggest offenders when it comes to this particular issue? And I'm going to engage with them. I'm going to steward them toward more sustainable way of doing business so that I address the problem in achieving my objective. So for us at Old Mutual, when we talk about responsible investment, it doesn't exist without that stewardship component, right? It's so important. And that's how you get to the sort of future that we want, where there is still enough companies to invest in, right? Where we do still have diversity, where we have a resilient and stable market to earn returns in.
And in general, I mean, when you have these engagements, are the management of these companies, and maybe you can give it a couple of examples, and maybe not, are they on the same page, or is it like they actually like absolutely we buy into what you're saying? We want to make a change for the better. We see it actually as better for us, better for the environment, etc. Or do you get a bit of pushback? I'm sure it's a bit of both.
Yeah, it's definitely a mixed bag. So, I've been here about 5 months now doing this particular role. And there are some companies that really get it, that are on board and they're trying, they're doing everything they can. They need guidance. This is a very new way of looking at your company and understanding your risks and developing your strategy. So they do need some help sometimes, but there's some companies that are 100% on the page. They understand the logic, they're behind. Then there are others who just do not understand, right? And they don't necessarily buy into the concept of sustainability. They have a very short-sighted approach. And those are the ones that are, I suppose, more challenging conversations to have. But that's why we have escalation processes in place so that we make sure, like I said, the most important thing is to have leadership that gets it. And so the starting point for us is the conversation around, do you get this? And if we don't feel like we're going to have that traction, that's when we start to use other tools in the stewardship toolbox, which is things like proxy voting, so voting against the election of directors, sending that signal to the company that we're not happy with how leadership is handling this. Voting in something like your remuneration policy to say, we want ESG or sustainability to be linked to executive remuneration. We want part of your bonus to buy your next yacht to be linked to how sustainable this company is. And that's when we can use those kinds of tools.
So talking about remuneration, because I know, again, it's been a hot topic for a while now. It's been in the press a lot. And I know, again, reading your sustainability report is probably the one thing that you guys vote against the most. I think it is the one thing you vote against the most.
The implementation report.
And so now, again, so what kind of, and one of the things I read there was that actually it's often is that the remuneration is not necessarily linked to the business goals as well at times. So can you give us a sense exactly of, I mean, again, it's different with all, but a sense of kind of how that is. And again,
So I think what's what I will say is that, so I'm an economist by training, and I believe in meritocracy, right?
Yeah.
So absolutely, reward performance, cool, that's no problem. Where we find a big problem and where we end up voting against implementation reports a lot is when remuneration is awarded devoid of any link to performance.
Yes.
Right? Where someone's got some sort of massive bonus, and when we push them to understand, but what was that for? There is no rational explanation. There's no link between what this person did and how the company performed, right? So you ended up being rewarded based on being
like a great place to work.
Yeah, you're in the right place at the right time.
Yeah.
So you got a big whack of money.
Yeah.
And that just does not sit well, right? Because it should be, what we want is remuneration policies that are linked to performance, that say, look, you're going to be rewarded as a leader of this business when your leadership is good for the business.
Yeah.
The business does well because you did well,
Yeah.
you will be rewarded. Not the business happened to do well, and so you get a massive bonus.
Yes.
So that's really the main thing. And increasingly, like I say, our big focus is on, we want those sort of sustainability linked criteria, things like transformation, which are so important in this market. We want leadership to be rewarded because they put in effort on that.
Yeah.
Right?
Yeah.
It's really important. Things like sustainability, we want to see that you're thinking about this as a strategic component of leading this business, not an add-on or sort of a grudge purchase kind of thing.
Yeah, and obviously inequality in our country is a huge issue.
Yeah.
I mean, and again, I don't know the stats, but I mean, I imagine kind of your executive pay down the line is still completely misaligned.
Yeah. So I mean, that's an interesting topic as well, because so inequality is a problem at a national level. So the most unequal country in the world, right? What executive remuneration and why we push so hard for disclosure of that wage gap, what that tells you is about the inequality within a company. Arguably, in a country where we have 40% unemployment, it's only telling you about a very small part of the market, right? The real inequality is between formally employed and informally employed, or between employed and unemployed people, which obviously one company's disclosures is not going to tell you, but it is a great starting point. It's a question of, you know, are we making this better or worse? And we're increasingly asking for disclosure of the gap, not just between your highest and your lowest paid worker, but on racial lines, on gender lines. We want to understand between sort of differently abled people as well. So we want to understand what's the principle behind this. Because that's really what we're focusing on. Is, like I say, we're a long-term investor.
Yeah.
Our preference is to remain invested in perpetuity unless a company gives us a reason not to be there, right? Once we've made that decision. When we look at issues like inequality and we use executive remuneration or the pay gap as a proxy for your impact on that systemic issue. So are you operating in a way that is making that worse or making that better? Because what you're doing is you're either contributing to stability or instability of the market. And we want a stable market. Okay. So if you are going completely grotesquely overboard with your remuneration, that's going to have a destabilizing effect on the market, right? Because you're going to have unrest and unhappy people. And we've seen what that looks like. And so that's why it's so important again. So, you know, intuitively, you know that there's something just morally wrong. You get to a point where a person can't possibly have earned that money, right? But that's not the core focus. We're always bringing it back to, is this affecting the ability of this company to be sustainable and stable, which is what we want as a long-term investor. So we do it partly because obviously it's, you know, morally and our values are aligned, but also because it has a direct link to the sustainability of this investment.
Do you think a lot of our large corporates got a short-term focus versus long-term focus, and the remuneration is actually geared around that? So Absolutely. It's real kind of, it's a 1 year number, hit your target, you get paid. And actually, I mean, of course, they should all be long-term gains.
No, of course, yeah, that's what you want, right? I mean, don't even get me started on a retention scheme, which is 2 years. Like, who are you retaining for 2 years? That's long. That's not as long as like someone doing articles. That's ridiculous.
Yeah.
So there's definitely a short-term focus, and that's a paradigm shift that needs to happen. And I'm not sure how we do that. I do find that in some organizations, or most organizations that really are driving and are at the leading edge of sustainability, they've got a person or a team that really believes in this and that has that long-term sort of vision. increasingly, we're seeing sometimes it being supported by a remuneration policy that has like a 5 or a 10-year vesting, which is great to see, because then you've got leadership that really is invested in how this company performs over the long term. But the vast majority at the moment are still very short-sighted, it's a real shame, because talk about cutting your nose to spite your face.
Yeah. And again, I guess you're a good friend of mine who works in sustainability in one of the large banks. And and she's a really important person in the organization. But often we kind of think, maybe is it still a tick the box, or are these businesses actually starting to take this stuff a lot more seriously than they did 2-3 years ago?
Yeah, it really depends. I think what we've got at the moment is a lot of evidence of what happens when it goes wrong. Yes. Right? So we've got very clear examples of the financial costs, the turbulence that you feel when you handle it badly. So when you look at like a BP oil spill or Exxon, or we look at something like the VW emissions scandal, Facebook with the data leaks, poor governance. When you see that kind of thing, you've got really good evidence of what it can cost you if it goes wrong. What we're missing, and what's much more difficult to measure, is the counter view, right? Of what is the actual upside that I get, the financial upside for managing these things well. That's missing, and I think a lot of people are sort of waiting for that, or would like to see that before they take it very seriously. So at the moment, we're playing a game of managing downside risk as opposed to shooting for, upside. And so it's a little bit more difficult to convince people. But I think it is changing, and luckily there's a couple of things that are helping them, which is the market demand. So people are increasingly, they want more sustainably produced products, they want more responsibly managed money, they want to understand, what are you doing, how do you produce these things, why is it so cheap, where did it come from, how many jobs did you create? They want to understand that. So that pressure is helping. And then policy and regulation is getting really involved. So globally, but also locally, we're seeing increasing pressure to disclose more, give more information, check your value chains, apply those standards throughout. We're being a lot more cautious about what we allow people to say in marketing and what they aren't allowed to say. So that is helping people along, whether they're sort of converted or not, they're being pushed in that direction.
So you said, I had a conversation with your colleague Pat a while ago, and she explained how the Gen Zs, they care about this thing properly. So in terms of like, they will not be investing in companies that are not green. They interrogate it, and a lot of the time actually so maybe like my generation, like we recycle, but actually the wealth will be passed down the line, and if we don't take this seriously, then that next generation will not give you your money. And socially we will actually force the change.
Exactly.
So now just bringing it back to kind of the investment piece. So a lot of this is this is all quite nice and interesting, but then how do you engage then with the investment team? Because obviously again, so they're crunching the numbers, they know who they want to be investing in. So what's that kind of engagement like between yourselves and the investment team?
Sure. So I think one thing I'll start with is that Old Mutual has had a dedicated, responsible investment team for more than a decade. So we're one of the only companies on the continent that's been doing this for that long. And when you talk about the number crunching, we're firmly doing that within the ESG team as well. We have a very definitive sort of quants and data analytics capability as well. And so it's not all sort of fluffy qualitative stuff, but because I think sometimes there's this perception. But how it works is that, our data teams are pulling information from external sources and feeding it into an internal bespoke scoring system, assessment system for all the companies that we look at, which allows us to identify who are the better and the worst performers in terms of ESG specifically, and what are the main material risks that they're facing, these companies. That's a great starting point for us for the conversation with investment teams, who will say, all right, we are looking at a particular industry or at these particular counters. What's the ESG view? So we bring that in and we say, okay, look, this is what our analysis shows us. These are the main risks that they're facing. This is how, from our stewardship activities, we understand management is responding. Do we think that's appropriate or not? Do we think that we could steward them in a way that mitigates this risk? And all of that gets factored into the models for the risk-adjusted calculation.
Okay.
So where's the start? Does it make sense?
Yeah.
Is it a good play? Does it meet our strategic sort of needs?
And I'm sure it's got some certain flags.
Yeah.
Flags, so red flag, hang on, like no go, yeah.
And that helps them in, and then, but at the end of the day, it's the portfolio manager to make the call about,
Yes.
which stocks to support.
Yes.
And then once we're in it, then, it circles right back around to say, okay, now going forward, how do we continuously monitor, make sure that things are getting better, not getting worse? And we feed back regularly to the teams to say, look, here's the engagement that we've had. This is how we're planning on voting. We are seeing progress. We're happy with it, or we're seeing developments that are going the wrong way. We think this is maybe more of a risk now. And so it's an ongoing conversation.
And it's built into the investment process.
Yes.
And that's, so the work that your team does goes into the investment team's investment process. So I don't have to ignore it if I'm an investment professional.
No, you're not allowed to.
You're not allowed to. No, exactly.
Yeah.
Okay, exactly.
Yeah.
Which is important. Yeah.
Yeah. So investors, I mean, you know this. We live and die by data.
Yes.
So we want as much information as is possible, and I think you neglect information at your peril.
Yeah.
So, we've got these teams that are working tirelessly on trying to understand, and not just, increasingly we're looking as well, not just at what are the big risks we want to avoid, but what are some of the opportunities that are bubbling up that we think we want to get in early on. And the ESG team is a big part of that role. I mean, we're looking at the moment at sort of what are some of like the small and mid-cap companies that we think are going to be the big deals of the future, and do we need to start stewarding them now and getting involved now so that we're ready when they're ready. So yeah, and it's all interconnected. And like I said, when it's those two sort of processes around the asset allocation and the stewardship, they're reinforcing and they're always working together. It's a continuous conversation.
Can you give us an example of a company where you look at it not on paper, but like from kind of a consumer lens, you go, oof, these guys can't be good for the environment. But actually you are having some very positive conversations with them in terms of making change.
Yeah, so the one that comes up always is Sasol, right? Yeah. So we focus on listed equity space. So otherwise, I would talk to you about Eskom, but that's in debt. But
go there. No.
It's not my circus. Yeah. But when we talk about something like Sasol, right? So one of the big concerns that you might have when you were talking about the Gen Zs who don't want to invest in anything that's not perfect, Sasol is a big one because environmentally it's atrocious. We can't even beat around the bush.
And even like someone like me who sits here, I can tell you it's atrocious because you can just see
it's horrendous.
Yeah.
It's horrendous. And internationally it's acknowledged as being a horrendous performer, right? So we don't have to, no one needs to beat that horse. So, but socially it has a significant impact because it creates a lot of employment and it has a significant economic function for this market, right? So back to our sort of philosophy around, does it make sense to just kick them out?
Yeah.
We can't just pull, even though they're responsible for about 40% of the carbon in our portfolio. It's one company.
And what's your holding? Do you know across the board? Do you have any idea?
No, I don't.
Okay.
So I'm focused on like the percentage of carbon at the moment.
Yeah,
so they're our biggest culprit. They're our problem child, right? And if you look at it right now, you'll see that it's still bad and it's got a lot of work to do. But if you compare it to where it was in 2014, when we started deliberately engaging with them on climate, it's a completely different company, right? And it's a great example of how we have escalated our process. So we started with having these conversations around getting the right leadership in place to say, look, we need people who understand what the problem is and are willing to address it, to acknowledge it and address it. We weren't seeing traction on that, so we had to use some of the proxy voting, vote against some directs, till we got leadership on board who said, okay, fine, we'll put together a plan. We acknowledge this is important. Great. Then we said, we want more information. We need disclosure from you on how you're doing, on like what is the strategy and how are we progressing. And there was pushback on that, so we escalated. We reached out to other investors. We filed a resolution where we required a climate strategy.
So you said other investors, like other asset managers?
Yes, other asset managers. Okay. So we put out a call to our peers and we said, look, this is not something that only affects us.
Yeah.
We think it's really important. And they came on board, and so we did a joint filing.
Okay.
Right? And so now Sasol has a
and that's not collusion, eh? No.
Okay. So that's okay. So this is a great one because there's a huge pushback in South Africa about collaborative engagement because people are worried about acting in concert. And Bowman actually, like 3 years ago, did a great piece on ESG collaborative engagement, ESG focused engagement in South Africa, and they found that it's not acting in concert because you're seeking to change a behavior, not change the ownership of the company, right?
Okay.
So it's not acting in concert, please collaborate.
Cool. Back to
yes. And so we filed that, and then it got a lot of support from shareholders. And so now Sasol has a net zero strategy. They disclose on that every year. There's still a lot of work to do, admittedly, but now we are so much better off than we would have been if we had just said, you know what, this is too hard, and just divested and left. And now we've got real potential with a company like Sasol to continue to steward them, to say, okay, next step. Now you've got this plan for the environmental angle. What's the plan for the people?
Has their mindset shifted completely?
I don't think it shifted completely. I mean, their instinct, as with most companies, their instinct will always be to try and protect their short-term interest, right? But they are, whether their mindset has shifted around, whether they truly believe that they should be changing, I think is less relevant than their behavior has shifted.
Yes.
And they're now planning for it because they're expected to report on it. They're also subject to Climate Action 100+, which is the largest collaborative engagement globally on climate. So they have pressure from all sides from around the world to change what they're doing. And so whether they believe in it or not, they have to do something. And that's great to see that the progress is slower than it would be if they were converted. Let's just say that.
Yes, no,
but they've put a lot of effort in, and they've got great people in place that are really doing work now. And that's been great to see. Again, I will caveat by saying they have a long way to go still.
Yes.
And that's the nature of stewardship, right? It's never finished. Because companies will always be nothing more than a collection of people, and people are imperfect. There will always be things that need work, and that means there will always be stewardship. So I will always have a job.
Okay, there you go.
Which is great.
Cool. Okay, we've got lots of questions.
Oh,
good. Jeepers. Yeah. So we're gonna get onto those quickly. So I'm gonna read them out. They've actually been coming through while we're chatting. So apologies to the audience if they are a little bit out of order in terms of where we are in the conversation.
Okay.
But I think we should to get into it. Okay. So first one from Anonymous. I do like names, by the way. So if you can put your name, please do so.
Please do.
Some people see ESG as fashionable investing strategy, but the trade-off comes with low returns, as some of the more profitable investments are not ESG compliant, which is ultimately what all investors are after. Do you track the opportunity cost of making ESG allocations, and how are these displayed to clients on fact sheets or via communication with clients? And that's a really good question.
Yeah, so that's a great question. Are we doing one at a time?
Yeah, definitely.
So that's a great question. I think first we need to dispel the myth that ESG integration necessarily results in lower return. So all the evidence and the academic research, and there was a meta study that was conducted a few years ago that looked at over 2,000 different studies, all shows you that effectively integrating ESG into your investment strategy does not result in lower return. At worst, it's the same return. At best, there's a bit of an uptick. Intuitively, we understand this because companies that operate more sustainably, that understand their ESG risks, that integrate those effectively, they tend to have lower risk, they have lower risk profiles, they have a lower cost of capital, they have better loan spreads, they have better customer loyalty. These are all things that you want in a company in your portfolio, right? So intuitively, you know that they make sense. I think what you will find is that where you might suffer in terms of return is if you apply something like a hard exclusion policy. So for example, in recent months, if you'd had a fossil fuel exclusion, you would have suffered, right? Because there's been a boom, a short-term sort of boom for fossil fuels, and then you've got some explaining to do, which is why that's not our approach.
Isn't a lot of it's potentially like a short-term kind of trend or market event could cause a kind of a boom, but again, the long term, that's not the case.
Absolutely. So, and it's also when you say, in this question, they talk about ESG investing, which is not really a thing. And that's where the confusion comes in, I think, is that what you're talking about, I think, is what might be considered sort of green investing, which is where you only invest in things that meet specific ESG criteria. What we're doing is responsible investing, which means we don't necessarily kick out a Sasol because it's performing terribly, because we know we can steward that towards something better. So it really depends. If you are cutting entire parts out of your investable universe, you are going to feel that. I do think that, there's no dancing around that, that's for sure. But if you are allowing yourself to still have a piece of everything, then, and you responsibly are investing in that, you shouldn't have a problem. And again, it's a long-term perspective, right? So if you are seeing that there's a problem with, and it's risk-adjusted return as well. That's what I think people forget. It's not, you've got to think about, is it appropriately adjusted for the risk?
Cool, shot. I think actually was, by the way. So thank you.
Okay, thank you very much.
There you go. So exactly. Okay, next one. Fund managers have an existing fiduciary role expected of them to steward capital in a responsible manner. Is this correct? If so, what is the difference to what you are proposing?
Yeah, so absolutely. Okay, so as a fiduciary, your responsibility is to act in the best interest of your clients. And it's the best for us as institutional investors, the best long-term interests of our clients. For a long time, that was understood to mean simply maximizing return. We know now that people's interests extend beyond just return. And so you need to start thinking about not just in pension funds, for example, are we going to retire well, but what kind of world are we retiring into? And are we using our money to do this? So ideally, in a perfect world, every investor, every asset manager would be a responsible investor. They would be thinking about ESG in their asset allocation, and they would be actively owning those assets and stewarding them well. What we tend to find is that we don't live in a perfect world, and that many managers are only doing one of those things. Or when they are trying to sort of focus on the stewardship, they might be doing so on very specific issues with limited efficacy. If you're a big asset owner and you've got multiple managers working for you, they're having multiple conversations, and it dilutes the impact. What we are doing now, and especially through our sort of standalone stewardship service, is offering the ability to consolidate that conversation so that we can leverage collective insight and a bigger voice and have one conversation once with more firepower. And that helps you have more effective sort of behavior change. So that's what we're focusing on, is really.
So actually the next question, I think, is quite a nice follow-up question. And it's from Sean. Is responsible investing stewardship more an active manager role than for a passive manager?
Thank you, Sean. This is one of my favorite questions because there's no such thing as passive investment. So I actually just yesterday had a sit down with our head of customized solutions, which is sort of our indexation function. And the amount of work that goes into putting together that kind of product is mind blowing. And I don't know why we call it passive investment. Yeah. They put so much effort into building those. And remember that even in a passive product, there's an underlying asset that needs to be actively stewarded. So when I engage on behalf of Old Mutual Investment Group with companies, I don't look which product this company's in. They could be part of active portfolios and passive portfolios. They're getting that same engagement effort because the same material ESG factors remain relevant, the same risks exist, the same opportunities exist. So it's absolutely relevant for passive and for active managers.
Yeah, I think that also is a bit of a myth that
yes.
think, yeah, it's also, I picked that up as well.
Yeah,
and we at Standard, there's quite a big also kind of index team. Yeah, and the amount of work they do is also
and a lot of them have got a significant ESG overlay now.
Yeah, and they
because it's a risk mitigator, right? Yeah. So it's a way for you to achieve comparable return with a much lower risk of ESG incident, which is beautiful thing.
Yeah. Next one, which actually was a question from before. How easy is it to obtain or extract data related to ESG support within an organization? Corporates report differently. And again, I think this is something we spoke about beforehand, is there isn't a lot of necessarily standardization around how you report on ESG, but I think it might be coming.
Yeah, so there's definitely a lot of work, and another good question, there's a lot of work ongoing at the moment globally around standardizing reporting. I think the most important thing for us as investors to remember is that, well, I said we sort of live and die on data, right? We want information, but what we want is decision useful information. So it's not a question of just getting a whole bunch of random numbers because that's what GRI says is relevant.
Yeah.
You need to say which of these data points is going to help me make a decision regarding whether or not this investment makes sense. Or in my case, which of these data points do I need to actively guide my stewardship activity so that I know where we're focusing. So things like, is this linked to exec rem? That's a really big important data point for me, but it might not be as relevant for somebody else. So I think it's in terms of, is it difficult to get that information? It's very difficult if you don't ask. I think the first thing you need to do is ask for it. What we see with something like Sasol is that you can push them to disclose on things that are beyond the required disclosures, right? The required disclosures, obviously part of our engagement activity is also beta engagement. So we engage through industry bodies and directly with policy and creating an enabling environment. So there we're always working on, can we change the Companies Act, for example, to include a requirement for pay gap disclosure? Because that will help. But then engaging with the companies to ask them for information beyond what they are required to disclose is possible. They don't always have it, but there's usually a proxy available. And it's really a conversation. It starts with the understanding, if you don't know what you want, then it's very difficult to get ESG data. If you know what you want, you can ask for that and you can usually get what you need.
So I suppose the challenge that comes out here is like, so from an advisor perspective or a retail client perspective, how do I know? So I can go to that individual who wants to know. So it's all good and well using OMEG as the example. We know you've got a process. You've got a team that kind of produces it. Do you show that stuff on your fact sheets or on your marketing material as an example? But again, you're asking certain questions that other companies might be asking different ones.
Yeah.
I think that's probably the challenge for the guy on the street. Is it, how do I know what I'm looking at and is it relevant to me?
Yeah, and I think a lot of that is, I mean, for individual investors, for retail side, it's really about what matters to me.
Yeah.
And I think, there's a lot of research out there around what are sort of the most relevant or material issues. We have, as a house, the issues that we've identified that we think are material for this context in which we're investing. And it's all available publicly on our website if you want to go look at our policies and our guidelines around how do we gauge these things. We've also got some coming near the end of this year, beginning of next year, things that we're going to be upping the ante on in terms of engaging with companies regardless of what sector they're in, or how big they are on specific issues that we think are really important. So you can always use that as a proxy. And then there can always be things that matter to you, that you want, that are important. So we've got specifically, some stewardship clients who are very focused on something like transformation. So they want to understand that at levels far more than what you see on your BE scorecard, right? And they want to understand that for every company that they have a piece of. Yeah. And so we're engaging very heavily on that. And so for them, we can give them that sort of information. So if you're looking from retail, I think one of the ways that you can look is that the products, and this is where this whole greenwashing thing comes in, there are products that are designed to take into account some of the most material issues. So if like ESG is something that you're very passionate about, then you can look for products that are focused on that. So there's ESG leaders indices. So in the passive space, there's a couple actively managed funds. There aren't many dedicated ones, but we're working on one, so keep an eye on that.
Product hunt.
Yeah, of course. I had to. So there are opportunities for that. And then I suppose just talk to your managers and talk to your advisors and say, look, this is something that matters to me. How do I make sure it's taken into account in my products? Yeah.
I also do know like a lot of some of the data companies like a Morningstar, they do have ESG reports and they've got rankings. I think the risk you got again is that if it's just a pure ranking on data, it doesn't include things like your Sasol conversation as an example where things have improved.
Exactly.
So Sasol come out as, if you've got really a decent holding in Sasol, come out as really bad.
Yeah.
But
And different providers have got different methodologies. So you might find one company ranks really badly by one provider and really well by another.
Okay. Cool. So moving on, I have to find my place here. Okay. Another question. In the press, has your ESG process caught the latest debacle re Lonmin oil price manipulation, which the US regulator has recently fined over $1 billion? If not, why not?
I don't know. So I'm going to just straight up say that I'm not sure about that one.
Okay.
But I'm sure we would have. And again, it's not ESG integration is about managing risk. Our biggest risk is always what we don't know. And so when we see things we don't understand or that don't seem clear, that's the biggest red flag for us. But it's not a crystal ball. We can't forecast, fraud or criminal behavior. That's not something we can see coming.
Do you have a global lens as well? Or you mainly focus on local stocks?
So right now our focus for the active stewardship is on South Africa, but we do have global holdings, and there we work through an offshore partner and we make sure that their engagement policy is aligned to ours.
Okay. Cool. Happy. A few more questions, but actually, I'm going to get back to those. I got a question.
Okay.
Is it so? It's one thing we spoke about earlier, and I know you've only been here since May. But where is there an example where you've engaged with management and you've kind of pushed a certain agenda or saying, and actually you feel, chucks, we've actually made a mistake. We've made a mistake here. We've got it wrong.
So there hasn't been one where I think like, oh, maybe I've got that one wrong. There have been some where I feel like maybe I've been a bit harsh.
Okay.
And then others where you feel like, sure, I'm so glad that we didn't get the wool pulled over our eyes on that one, because there's been a couple where, you know, a lot of these companies, the people that you engage with are very cleverly selected and are very charismatic people. And so sometimes you'll go in with an agenda and be really sort of hard-nosed about it, and by the time the call is finished you feel like, oh, maybe they're not so bad, maybe we should rethink this one. So there's been a couple of those where
they're charming
sort of,
and
you think, oh shame, well maybe it was okay for them to get that 300,000 rand bonus because shame they put in so much effort, and then you sort of see sense and realize that no, that was rubbish. But there have been one or two where in these last couple of months where I do sort of look at it again and think like, maybe that was overly harsh, but I'd rather err on that side than the other.
And the wool over your eyes example,
oh wow, no, there's some really fun ones. My favorite is always around retention schemes, which in principle I do not support, because all they do is give you the exact number your competitor needs to pay to poach your people. So just think about that, guys. So retention schemes are great, or the ones where, you know, the biggest one that we're dealing with right now is around COVID bonuses, right? So during COVID, a lot of management teams and a lot of boards very magnanimously forewent their salaries or their bonuses because they said, you know, we're having this tough time and we don't think it's right that we should get paid or get our bonuses. And that at the time was so great, and amazing people. Thank goodness for them. And then this year,
no sarcasm.
And this year, they are doing everything they can to claw those back. So now it's a question of, oh no, I know that it's not policy, but we've got this once-off payment that we're making to this one exec because of some amazing input or some extra time they've put on something, when it's very clearly they're just trying to claw back something that they apparently sacrificed last year or during COVID, right? So there's been, that's something that we're dealing with actually a lot at the moment with companies.
So across organizations.
It comes up all the time, where all of a sudden, and that's when you vote against not the policy, but the implementation report. We say like, your policy is fine, but this is a clear deviation from that policy. What has happened here? You know, and they'll say, oh no, but you know, this was just it's a retention thing. We have to do it because of the brain drain. We're going to lose our leadership, you know. When you dig a little bit deeper, it's very clear that, you know, they've just been counting the seconds till they could reclaim that 2019, 2020 bonus.
So from a responsible investing point of view, and you mentioned COVID, do you feel corporate SA did enough through our kind of the last two and a half years with regard to COVID?
No, I don't. But my job and the nature of who I am as a person is to be permanently dissatisfied and have high expectations. But I do think we could have done so much more. I think there's some great examples of companies that really did more, and there's some that really took it to heart and managed to give all their employees like, you know, a little bit of a bump and really support them, and managed to have like a net positive job sort of creation number. You really have like gone all out. And then there's some that I think barely even noticed that there was a pandemic and just sort of carried on. So again, it's a mixed bag. I think we definitely, as a collective, I think could have done so much more.
Yeah, that's interesting. Again, it is a bit of a, can we overspoken the topic, but again, is it how different organizations dealt with COVID, and now how different organizations are dealing with the kind of get back to work post COVID, and it's completely varied, and the debate's out which is right and which one isn't. But I suppose time will tell. Cool. So we've got about 10 minutes left, and I probably haven't got through half the questions.
Oh gosh.
So it's fine. Ones we don't get through, we will pass on, and Pat can help us get them out. Only problem is there's a lot of us from anonymous. So I'm going to choose people who've given names to start with. Okay, from Matthew. No, I don't know. CRISA, C-R-I-S-A-K, CRISA 2.0.
Yep.
Code of Responsible Investing in SA is big on outputs and outcomes.
Yep.
Can you speak about the shift here, the difference between ESG inputs and ESG outputs, and how/if this can improve how we measure companies on their ESG performance?
Yes, and absolutely. So CRISA is the Code for Responsible Investing in South Africa, and it's recently undergone a bit of a revamp and relaunched as version 2.0. So that's what they're talking about. And we are obviously supporters of that, and we were on the working group and the committee that revised the first one. And so now as OMIG, and then in my personal capacity before that as well, I was involved with that. And what I will say is that it's always good to have guidance for investors around what does best practice look like. And you need to implement that in an appropriately nuanced way that suits the context of your particular case. The focus now on outcomes, I think, is right. It avoids then that tick box exercise. So it goes beyond just, do I have a policy in place and am I reporting?
Yes.
It's not as much about, so from a stewardship angle, because CRISA has a whole section around stewardship, which they call, I think it's diligent stewardship, so that it's not just active ownership, so that it includes fixed income. So I think that that's a great idea to have it focused on the outcome, because then the focus shifts from how many meetings did I have to the so what. What actually came of this? What changes have I seen? What does it mean in the real world? So what's the real world impact of these conversations? And I absolutely think that that is important. And I think it will shift how we assess the performance of asset managers on responsible investment, because it's not just about how much work are you doing? It's, how efficient and effective is that being? Yeah. Is it actually changing anything? So I think that's fantastic. I would love, and we can just put it on the record, I would love to see CRISA to be enforceable, which it's not currently, it's voluntary. So obviously a first step, if you are speaking with your advisors or, particular service providers, encourage them to sign up. And then hopefully we can hold them to account on that and say, okay, you've said you endorse these principles. Are you actually following through? Because there's no one who's going to be checking except for you. So please do check that your service providers are doing it.
And do you know who has signed up? I mean, you must have a list of who has signed up and who hasn't.
They actually just launched it, I think, 2 weeks ago. So it's not sort of out there yet.
Okay.
But they will put it on the website.
Interesting.
So through the IODSA, you'll be able to find all of that.
Yeah, cool. Okay. Another one from Sean. Thank you, Sean. How do you make me, the investor, feel like my contribution makes a difference? It needs to be more than a fact sheet statement. Current ESG mandates may be too broad.
So every rand makes a difference, right? So what I can attest to personally is that, so I spent the last 5 years with a UN-supported international NPO, right? And we were working on getting investors to invest in this way, to more responsibly. And that comes with a certain level of sort of gravitas when you engage with investors. It is nowhere near as impactful as representing actual money when you talk to a company. They have to listen because you own part of their company. And it's just a significantly different leverage. And every rand makes a difference with that. That's part of why, if you really want as an individual saver, as an individual investor, you want your money to go the extra mile, try and make sure that it's with a product that is actively stewarded. Doesn't have to be an active product, but it needs to be one that's with a house that those underlying assets are being engaged with, because every conversation that we have with them, we come into that room with this big pot of money that we represent, and it forces behavior change. They have to listen or they don't get that money. So I think if you want it to matter, I think that's really how you do it.
And that's usually important, because obviously, you're not a majority shareholder, and you can't be.
No,
because management
not always.
Management will have a big chunk, and there'll be the usual kind of the retail kind of investor, not outside of kind of funds and that. So what is the most, would you say, do you think you own in a particular stock? 20%?
No, it depends. There's some where we are quite, on some of the smaller ones, like the REITs and stuff, where we own like 50%.
Okay. So there you obviously have, then you got
every vote matters, every conversation matters. Some of them, even if you're having a conversation on 4%, on some of the votes, if they don't get 85% or 75% buy-in, they have to resubmit it. They have to go and engage with their shareholders.
Okay. Yeah. So
it can make a huge difference, that 4%, 1%, 0.5%.
Okay, cool. Another question which I think is an interesting one. So we've spoken about kind of very much the asset managers and the active stewardship that they have with organizations and remuneration. Would you say the active managers and their execs, are they aligned to kind of these remuneration conversations?
Well, increasingly. So here at Old Mutual, I'm very pleased to report that there's a big ESG component in our executive remuneration.
Okay.
So it's a big part of what they do. And so we've signed up as Old Mutual Investment Group and as Old Mutual Limited to net zero. And it's that target and the progress achieved on that target is linked to executive remuneration. So it's a huge part of their day-to-day is thinking
and then
about
on the short-term goal and pay and activity.
Yeah, I think it's a tricky one because the system is fundamentally set up for a different prioritization, unfortunately.
Yes.
And so we're still, we're investing with this sort of institutional investment 30-year horizon. And we're still having to report on progress every quarter. Yeah. Which to me is just ludicrous. It doesn't make any sense. And we're still reviewing these things annually or every 3 years when some, engagement takes a long time. Yeah. Something like Sasol, it's been more than 10 years almost that we've been having these conversations. So it is fundamentally broken, but it's increasingly improving. So more and more, when you think about the average client report back, for example, ESG wasn't even on the agenda 5 years ago. Then it was the last thing and there were maybe 3 minutes. Now some entire sessions are just focused on that. Yeah. So it's getting better. It can always improve. But I think what our investment teams understand is that ESG affects the performance of the portfolio and their remuneration depends on the performance of their portfolio. So that link is very clear for them.
Okay, no, cool, happy, thank you. I think probably the last question from Gregory. Sorry, Gregory, I did miss this earlier. Are there medium-term and long-term ESG deadlines for those who are being stewarded? And is this transparent disclosure of changes in portfolio holding as a result of investment not achieving OMIG's ESG stewardship criteria over an agreed period?
Yes. So Gregory, great question. And the answer is we're working on those now as part of our signing up to the Net Zero Asset Managers Initiative. We are required to have in place a strategy for getting our AUM, our portfolio to zero, net zero emissions. And as part of that, we have to set short, medium and long-term goals, and those will filter down into the company. So we're currently building those frameworks internally. They have to be ready early next year. So you'll see them, and that will directly translate into sort of scorecards that we have for those companies to say, you need a transition plan. This is what, the science tells us for your industry, for your company is an ambitious but pragmatic objective for the next 5 years. We need to see that met. We need to understand. And then as we go, we'll obviously be reporting on progress because as we know, this field is rapidly evolving. It's very dynamic. And so there might be really good reasons why you don't meet a particular target, but it might not mean you won't meet the future ones. Again, it's about whether it's in your control or not. But all of that we'll be disclosing in our TCFD reports, which will start coming through thick and fast from next year.
It's really, again, it's probably a very fine balance again, because again, someone doesn't meet their kind of the goal, because you say to disinvest actually might be worse.
Yeah.
So it's that whole continuous conversation.
Exactly. So divestment for us is an absolute last resort when everything else has failed. When you are 100% certain that not even that engagement will not yield even a marginal improvement, then you've got no choice. Okay. But luckily there's a long horizon on that. But to answer your question, absolutely. You have to break down that long-term goal into medium and short-term. Otherwise, how do you assess progress?
Cool. We've got 2 more questions, but I almost feel out of time. We're trying to get one in. And sorry, Sean, I've asked 2 of yours, so we can chat about. I'm going to skip this one. This is from Andrew. What is the total cost to company to hire someone to fill the role / need of a resource to manage active stewardship?
Are you asking me what my salary is?
I don't know if we can actually. Thinking of
is that an offer?
Thinking of a Cat 2 entity to hire someone. Okay, so what? I think they're from a DFM perspective, if they wanted someone. But I suppose from a DFM perspective, they come to engage with asset managers who've then got the teams to do this for them.
Yes, and there's different ways to do it, right? So I think that's also important. So this is the way we are structured and the way that we are doing it. It's not the only way to do it. There are some asset managers where the analyst that covers that stock is also the one that leads the engagement, right, on ESG. That's also one way to do it. Then you don't need more people. You just need good people in existing roles. So there are different ways to do it. If you want to get sort of a dedicated person, that's a different structure. And we could talk about sort of how that's at cost. Or you can always get OMIG to do your listed equity stewardship on your behalf. And then just hire us to do that.
Yeah. Cool. We are out of time. We're done. So Nicole, thank you so much. I thought that was a really, really cool conversation. Really interesting. Great questions coming through. So always to the audience, thank you for attending. Big thank you to Nicole and the OMIG team for having us here in your offices. I think it's been fantastic. Just quickly, Sims, when's the next webinar? Can you remember offhand? Okay, there is an invite coming out soon. I forget, but there's definitely one coming out soon. Please look out for them. As usual, please follow us on LinkedIn, and you'll see all our webinars and all our bits and pieces come through there. Otherwise, that's it. And
great.
Thanks again.
Thank you. Thanks you, everyone.
Shot.
Innate is a registered trademark of Stanlib Wealth Management Pty Limited, an authorised financial services provider.